publicly traded preferred stock based on 100-year-old tax law, 100-year-old securities law, trading on, you know, the NASDAQ exchange, which has been around for who knows how long, longer than many of us have been alive. So everything that we're doing is sitting in a zone of regulatory clarity. I don't think we need any change in a law or a rule in order to 10x or 100x. We can probably be 100x bigger from here without any change in any law or any rule. We're not asking or looking for anything. I think that clarity is pretty important to the dynamic and the balance of power with regard to token issuers, DeFi exchanges, stablecoin issuers, crypto exchanges, and it determines the balance of power between the crypto industry, the neo banks, and the regional banks, and the systemic, the big banks, and so there's a lot of dynamics there that are almost too nuanced to get into right now. The significance to us is just ignorant skeptics will gloat if it slows down, and they will all flip to uninformed cheerleaders, you know, or acknowledgers if it passes. But there's not anything that we need. It's just going to change sentiment. It's going to be a positive, bullish sentiment as it goes through. Long term, if I look at my laundry list of things that are good for Bitcoin and good for us, it's a second order, not a first order, but the second order is the Basel rules, to the extent that they're upgraded to recognize Bitcoin as legitimate collateral and not haircut it. It would be positive for banking adoption and especially credit adoption, because right now there's still a bit of haircutting of it by the credit rating agencies and the very conservative regulated entities that they want a gatekeeper or they want a regulator to tell them it's okay. And so I think that at some point, if you want an insurance company portfolio manager to buy the product without knowing what it is or why they bought it, then it would be beneficial for the Basel rules to evolve and get an embrace of Bitcoin as a legitimate asset. Right now, we're selling to informed investors that want to buy the best thing. And if you look at that market, if we slurped up 10% of private credit, that's 370 billion right there. And so we've got plenty of runway for the next decade. But my wish, if I had one wish, is for the Basel rules to be fixed, and then for the world to recognize Bitcoin as legitimate collateral pari passu to gold or to other capital assets on banking balance sheets and regulated entities. Then it should spread faster through the banks as a reserve asset and through insurance companies and the like. But it's not necessary to us. We could be a multi-trillion-dollar company and sell $400 billion of STRC and not have that fixed.
You know, one thing I'll add, Randy, is Stretch is already a rapidly accelerating product in the category of digital credit. And that is without clarity as it relates to tokenization of securities, which I think will either be created through the passage of clarity or rulemaking by the SEC. That will only accelerate things. So we showed $270 million of layer 2 tokenized Stretch from companies like Apex and StockX by Kraken. Those are sold outside the US, not in the US. Right. And so when we get clarity, that'll only accelerate things and will accelerate layer 2 development on top of Stretch and just accelerate digital credit overall. So it's exciting to see what may come on something that's already an exploding asset class.
That's great. Thanks.
Thank you, Randy. I was just saying, saving the best for last, James Lavish.
Thank you, CJ. Congratulations on your new role. Fong, Michael, Andrew, thank you for having me and allowing us to ask questions. But first, congratulations also on your success with Stretch. You know, I'm a believer in the digital credit world. And I appreciate you all sharing the many levers that you can now use to create value for the common shareholders while protecting creditors. But on that, with Strategy's energy and focus on Stretch, which you've said before is a security you landed on through iteration. What do you see as the optimal future balance sheet structure for maximizing the accretion of value for common shareholders? And would that include retiring most or all of the other debt and preferreds currently outstanding? And do you believe that that's ultimately necessary to attract more of the largest institutions to invest in Stretch in lieu of traditional yield generating securities?
You know, we think we want to be debt free completely. So all 6 of the converts we make go away by either swapping them for Stretch or swapping them for equity or paying them off with cash. So I think there's consensus on that. I think there's consensus that Stretch is the killer strong credit instrument. I think the jury is still out on the other 4 credit instruments. They're all long duration credit instruments, and they represent important optionality for the company. And so I think that our policy will be to retire the 6 convertible bonds to promote and to polish the jewel in the crown, which is STRC, and then to watch and nurture the other 4 and improve them as we can, and then observe whether or not they're material and generating demand. I think right now you can imagine the company, if I was designing a Bitcoin treasury company from a clean sheet of paper, the company would consist of 1 common equity, 1 monthly or semi-monthly variable preferred equity, and a big stack of Bitcoin, and nothing else. Right? That's my advice I give freely to anybody that ever asks me. The other things are interesting, maybe, but not necessary. We'll watch them. It's very difficult to create a publicly traded instrument like Strife or Stride or Strike. So we won't retire it because it represents giving up billions of dollars of optionality. But on the other hand, what really is critical for us is manage the common stock carefully to get the MNAV up and the premium up, manage the Bitcoin stack, and then manage the monthly variable rate preferred, the digital credit instrument. Those are the things that really matter.
Thank you, everyone. That brings us to the end of the Q&A session. I'd like to thank everyone for their questions and all the attendees for joining and listening to the earnings call. I'll hand it back to Phong for any closing remarks.
Yeah, I want to first thank everybody for attending our earnings call. I know there's tens of thousands of you out there spending 2 hours and 15 minutes of your evening with us, and we find that to be very gracious and flattering. Many of you are shareholders of our common MSTR and our perpetual preferred Stretch. And as many of you know, we have a shareholder vote coming up that's due early June to primarily modify Stretch to go from, as Andrew mentioned, a monthly dividend to a semi-monthly, twice-a-month dividend. We believe this is beneficial to our shareholders. As we mentioned, one of our principles is to make Stretch better and more attractive. So we would appreciate you all voting early so that we can start to tabulate the votes. And this is how you can do it. If you have additional questions on how to vote for Stretch and for the common, you can also go to our website. And with that, I really appreciate your time. Thank you for all the interest and the attention. And we'll talk to you again, if not before then, at our next earnings call 3 months away. Thank you all.
The Clarity Bill, of course, is getting ready to get voted on this week. We'll break it down. I've got a special guest that's going to give us the insight to what's going on in D.C. Let's get started. I want to thank our sponsor. That is Uphold, where you guys can get a ton of rewards, including money back on their debit card. And one of the other things you can do there, of course, is staking rewards. That's something that is available on over 20 assets over on Uphold. So check it out using our link down below. All right, let's get into it today. I want to lead off the show with a clip that is kind of a culmination of where we stand right now on the Clarity Act and the stance that DC is facing. Take a look.
I think we do have a compromise that is going to make, the banks happy. We've given enough concessions. We've arrived at enough compromises where as high as 6 Democrats voting for it. So
an ex post, I should say, from Patrick Witt saying, and it's highlighted here, no bill is better than a bad bill. Of course, he's quoting your CEO.
This bill had less than 24 hours to breathe. We had 6 amendments that would have made the bill materially worse. It had the potential to shut down exemptive authority.
I'm not sure, where Coinbase was getting that is just false.
I would urge some of the crypto folks to be a little bit, to see the bigger picture. I bet you over time, the banks like the idea of paying yield because they're going to be in the stablecoin business.
But do you believe that? All right, so that was Matthew Siegel on Vanna. What we were getting at is the issue of yields. Should we be forfeiting those? If you are been watching at all, you guys understand this is one of the big sticking points of the Clarity Act. So I wanted to bring, of course, Cody coming in from the digital chamber. How are you, Cody?
Doing well, Paul. Thanks for having me.
Nice to see you again. Hey, listen, I'm going to give you the benefit of the doubt on that last statement from there. So I didn't understand where you guys are on this, but obviously there's a lot of issues that are happening right now in D.C. Where does this bill stand? Do you feel like this still has legs to go?
To be honest, we're in a tough spot right now, and we're kind of in no man's zone. We don't know what the future is. You just hit the nail on the head with that roundup. The prevailing issue right now, and what is blocking this bill from moving forward, is the stablecoin reward piece. There are other issues. There are ethics issues. There are some issues around DeFi regulation. There's some issues around quorum at the CFTC. But the main issue and what is holding this up and why the markup was delayed was stablecoin reward piece. Without a compromise between the banks and the crypto industry, we're not going to move forward. Mm-hmm. So we'll have Senate Ag move forward this week, which is great. It's half of the bill. It is a less controversial half of the bill. It is more on the CFTC regulation, giving the spot market jurisdiction to the CFTC. It is a needed step in the process, but until we figure out the stablecoin reward piece, we're not going to go anywhere. And it's tough to swallow, but that's why we need to be at the negotiating table.
Well, yeah, I understand the negotiation side. However, it does put us, and I say us, meaning the crypto industry, in a very precarious situation. We've watched Patrick Witt, obviously, I would say, instigating a fight publicly with Coinbase, which is, I would say one of the key authors, not authors, but definitely supporters of this bill. When you look at what he's doing, why isn't he blaming the banks? I mean, this should be, they're the ones that came in with the amendments. The banks are the ones that are now wanting to change essentially what has been done or preordained out of the Genius Act. Why are we not getting support from Witt in that area?
The banks are the reason why this is being held up. The banks were nowhere when it comes to Clarity Act. I had my team go back to see when the bill passed the House. I had my team to go back and say, did the banks make any noise? Did they oppose the Clarity Act when it passed the House?
You mean Genius
Why didn't
Act?
they want to?
Oh, when it went through
Clarity
the House.
Act.
Okay.
When it went through the House, the banks were nowhere. And the banks sat on the sidelines, and then the Genius Act passed, and they were on the sidelines again when the Genius Act passed, and said, oh, shoot, we didn't know about these things called rewards that were not new, Paul, as you know, that have been around since, 2019 when Coinbase started issuing stablecoin rewards, and they were just late to the game. And now, by entertaining the bank's negotiation tactics or amendments to this market structure bill, which we shouldn't be talking about stablecoins anymore because we dispense with that in the Genius Act, we have now set ourselves up for where we are forced to negotiate. And that is not Coinbase's fault. That is not the crypto industry's fault. That is the fact that there are a lot of Republican senators and Democratic senators who are sitting at home saying, I must listen to the banks. The bank lobby is very powerful. The bank lobby has the ability to influence votes in my state. What these Republican senators, and again, it's not just Democrats, it's Republican senators who are sitting in the Senate Banking Committee who are saying, I'm hearing from community banks that stablecoin rewards will put them out of business. We don't agree with that. It seems asinine to me. But it's the truth. And so while Coinbase had a big hand in why the markup was delayed, and I agree with a lot of the things Coinbase said in terms of Brian Armstrong's tweet of why they opposed the bill. Substantively, I agree. I think where I'm coming from and likely where Patrick's coming from is just like, hey, we have to sit at the table. Let's not walk away now. But to your point, I couldn't agree more. The banks deserve all of the grief here and why this bill is being delayed. The silver lining here is that if we do nothing, Coinbase wins, the crypto industry wins in terms of stable coins, and the banks lose.
Yeah.
And so the banks need to negotiate, because the status quo for the banks and say, hey, we're going to tank this bill, we're going to do nothing, is that rewards will continue. It's a loss for them. So I think what Patrick is trying to do, and I think what we're trying to do, is let's get everyone back to the table. We now understand, despite as much as we have advocated for to Republican senators, that they want to listen to the banks, that they think rewards are a problem. We don't agree. We'll continue to educate them on that, but that's where we are today. So if we want a market structure bill, we're going to have to address this, but we're not going to accept a bad provision and a prohibition on rewards. Can't accept it. We understand that. So that's where we are today, and that's why this bill is being hung up.
All right, so this seems like a negotiation situation that is brewing. I want to play this clip from Patrick Witt, and then we'll comment afterwards. Just take a look at this.
Sure.
We have some work to do to convene, play a bit of a mediator role between the folks on either side of the stablecoin rewards and yield debate.
Does the White House have a position on interest-bearing stablecoins?
We don't necessarily come out one way or the other. We've heard from a number of Senate Republicans concerns about what this could mean for community banks in particular. We're not deaf to those concerns. It's going to require some folks to make difficult decisions that might hurt one part of their business. It's not just exchanges, it's broker dealers, it's folks writing DeFi code.